Hello everyone, welcome to the 103rd episode of me learning how to trade in Forex. So in the last episode we went through the Australia country profile, and then we went through a bit about the New Zealand country profile. So read through some basic facts, figures and features, looked at the economic overview, some monetary and fiscal policy, and now we're up to getting to know the NZD, which is the New Zealand dollars. So let's get started. Getting to know the New Zealand dollars. The New Zealand dollar is nicknamed Kiwi. It's a bird, it's a plane. No, wait, it's really a bird. This is the Kiwi. The Kiwi also happens to be a national symbol for New Zealand, but let's focus on the Kiwi as a currency and its interesting characteristics. Show me the commodities. Whoops, that's the wrong slide. Since New Zealand's economy is mostly dependent on its exports of commodities and agricultural products, the overall economic performance of the region is linked to commodity prices. So, the overall economic performance of New Zealand is linked to commodity prices, since New Zealand's core economy is mostly dependent on its exports of commodities and agricultural products. If commodity prices rise, then the amount of money paid for New Zealand's exports also rises, which then makes a larger contribution to the country's GDP. Since a higher GDP reflects a strong economic performance, it could lead to an appreciation of the Kiwi. If commodity price rises, New Zealand export price also rises, making larger contribution to the country's GDP. Higher GDP leads to high GDP reflects a strong economic performance, which strengthens the NZD. Conversely, falling commodity prices results in a lower monetary value of exports, making a smaller contribution to GDP. A lower GDP could then cause the Kiwi to depreciate. I move hand in hand with the AUD. Since Australia is New Zealand's #1 trade partner, the economic performance of Australia has a huge impact on New Zealand's. Performance of Australia has a big impact on New Zealand. For instance, when the Australian economy does well, Australian firms pump up their importing activities, and guess who benefits from that? New Zealand, of course. So good Australian economy benefits New Zealand. And just like the AUD, I enjoy carry trades. Just like Australia, New Zealand enjoys high interest rates compared to other major economies such as the US, the UK or Japan. New Zealand has higher interest rates. Interest rate differentials between economies often serve as indicators of money flows. Since investors prefer to receive higher returns, they would sell lower yielding investments in exchange for higher yielding assets or currencies. In other words, the higher the interest rate, the more the money flows in. Meaning it's good for carry trades. I'd like more migration, please. Because New Zealand's population is less than half the number of people living in New York City, an increase in migration into the country has a huge effect on the economy. This is because as population grows, the demand for goods and overall consumption increases. So that means what? Is that good for the economy or is that bad? So if there's more people going into the economy, if there's more people in the country, demand for goods and overall consumption rises. So then more imports are needed to sustain the population, right? If your country needs to do more import, then it needs to convert more of its own currencies to convert more of its own currencies to the other country's currency. So your country is going to be in less demand than the other country's currency. So it could potentially weaken the NZD, maybe. Oh, I'm weather sensitive too. New Zealand's economy is also largely driven by its agricultural industry, which means that severe weather conditions such as droughts have a huge negative impact on their entire economy. Severe weather conditions have a big negative impact on their economy. Those heat waves are also prevalent in Australia, which is more frequented by forest fires, costing close to 1% of its GDP in damages. This doesn't do the NZD any good. Because remember, Australia and New Zealand's economy are very closely linked, so if one does well, then the other does well, but then if one doesn't do well, then it also affects the other one. So, important economic indicators for NZD. GDP, whoa. Just like any other nation, the gross domestic product serves as an economic report card for New Zealand. By serving as a gauge of the overall economic performance, measures the overall economic performance for New Zealand. It influences demand for the NZD. CPI, Consumer Price Index. The Consumer Price Index measures the change in price levels. As a measure of inflation, it is closely watched by the Reserve Bank of New Zealand in determining changes in monetary policy. They're supposed to maintain price stability, remember? Therefore, closely watched by the Reserve Bank of New Zealand. Yep. Balance of trade. So, balance of trade. Since New Zealand is an export-driven economy, traders often take a look at their trade balances to gauge the international demand for New Zealand's products. Looked at to gauge the international demand for New Zealand's products. So if there's more demand for New Zealand's product, then there's going to be more currency. There's going to be more demand for New Zealand's currency, which is NZD. So therefore, if there's high demand, then its value is going to rise. So it's going to strengthen the NZD. What moves the NZD? Economic growth. Positive GDP growth reflects the strong economic standing of New Zealand, boosting demand for its currency. Negative GDP growth highlights the poor economic performance of the country, dampening demand for the NZD. Yep. So positive GDP growth boosts the demand for NZD, which strengthens NZD. Negative GDP growth decreases the demand for NZD, which weakens NZD. Surge in exports. Higher demand for New Zealand's product often results in higher GDP, which then boosts the NZD. Higher demand for New Zealand's products often result in higher GDP, which boosts the NZD. Lower demand for New Zealand's products often result in lower GDP, which weakens the NZD. Rising commodity prices. Increasing commodity prices causes the monetary value of New Zealand's exports to rise, pushing its GDP higher. Increasing commodity prices cause the monetary value of New Zealand's exports to rise, which increases its GDP. Decreasing commodity prices cause the monetary value of New Zealand's exports to fall, which decreases its GDP. Trading NZD USD. Since the counter currency is the US dollar, why is that different fonts? The changes in value are measured in greenbacks, aka the US dollar. On a 100,000 unit NZD USD position, each pip movement is worth $10 US, while on a 10,000 NZD USD position size, each pip movement is equal to $1. Margin calculations are based in US dollars. For instance, if the current NZD USD rate is 0.7 and leverage is 100 to 1, 700 USD in available margin is required for a 100,000 NZD position. A 10,000 NZD position requires 70 USD in available margin. You see, because of Kiwi's relative low value against the US dollar, it requires the least amount of available margin among the other majors. That means it's cheaper to trade the Kiwi. Okay, yep. NZD USD trade tactics. Strong economic reports from New Zealand results in an appreciation of the NZD, so if there's a good chance that an economic release could beat the consensus, it should be assigned to go long NZD USD. Go long NZD USD because you're hoping that So you're hoping the NZD to you think that the NZD is to appreciate, which means NZD is going to be strengthening against the USD, right? So if NZD is strengthening against USD, then you're going to require more USD in order to trade one NZD, which means you should buy NZD USD because you're hoping for the value to rise up, because you need more USD to buy one NZD. Okay. Weak economic reports, on the other hand, often push NZD down. If an upcoming report is likely to come in weaker than expected, it could be a chance to short NZD USD. So shorting NZD USD for the opposite reason why you would go long NZD USD if you got a strong economic reports. So strong economic reports results in an appreciation of the NZD. Weak economic reports results in a depreciation of the NZD. Aside from watching economic reports, taking note of commodity price behavior could also serve as an influence on NZD USD price action. Commodity price behavior could also influence the value of NZD. In recent history, commodity prices tend to surge when demand for riskier assets is also strong. So in recent history, commodity prices, so that's like gold and oil and all that, tend to surge, tend to increase in value when demand for riskier assets also is strong. When there's demand for riskier assets. During these times, investors place their money in higher yielding assets such as gold and other commodities and sell the lower yielding US dollar. As a result, the commodity-based Kiwi gains strongly against the safe haven US dollar. Commodity prices tend to rise when demand for riskier assets also rises. As investors place their investments into higher yielding assets such as gold and sell the safe haven currency of USD. Therefore, NZD strengthens against the USD. On the other hand, when risk aversion forces investors to flee back to safe havens, the NZD edges low against the USD. Yep. Just like the AUD, the NZD is also a good candidate for carry trade. Since carry trades involve buying currency of high interest rate and selling currency of low interest rate, New Zealand's relative high interest rate provides support for the NZD. And I've written that before, so I won't write that again. Okay, that's NZD done. New Zealand dollar. Now we're on to Switzerland. 12. So, Switzerland. Switzerland was founded in 1291. That's a long time ago. And is located in the middle of Western Europe and shares much of its history and culture of Germany, Austria, Italy and France. Although being right smack in the middle of Europe, Switzerland is not part of the European Union. Oh, it's not? While there are talks between the EU and Switzerland in the mid-1990s, the Swiss public rejected the proposal to be part of the EU. Since then, Switzerland has maintained its economic independence. So, not part of the EU, maintained economic independence. So it's not affected by EU regulations then. So Roger, what's the biggest advantage of living in Switzerland? Well, the flag is a great big plus. Well, hey, Switzerland is considered to be a small country, but let us tell you that it is packed. It has a population of about 7.78 million, with around 477 people per square mile. Switzerland is also known for its neutrality, as it is refrained from participating in either of the two world wars. Right, Switzerland, facts and figures and features. Neighbours, Germany, France, Italy, Austria. Size, 15,940 square miles. Population, 7,954,700. Density, 477.4 people per square mile. Capital city, Bern. President of the Swiss Confederation, Guy Parmelin. Currency, Swiss franc. Main imports, machinery and transport equipment, medical and pharmaceutical products, other chemicals, manufactured goods. Main exports, chemicals, clocks and watches, food, instruments, jewellery, machinery, pharmaceuticals, precious metals, textiles, Rolex, Roger Federer. Import partners, Germany 26.19%, Italy 10.46%, France 8.4%, United States 6.08%, China 5.75%, Austria 4.4%. Export partners, Germany 18.5%, United States 11.61%, Italy 7.61%, France 6.96%, United Kingdom 5.67%. Time zones, GMT +1, website, myswitzerland.com, EN-US. Economic overview. Switzerland is one of the richest countries in the world in terms of per capita income. That's total GDP divided by the country's population. Switzerland's GDP was $679 billion in 2017. As small as it is, on a per person basis, it boosts a GDP of 68,060, which is the 8th highest in the world. Its main trading partners are Germany, the US, France, Italy, Austria, Russia and the UK. Like Japan, Switzerland is also highly dependent on its exports. Switzerland is highly dependent on its exports. Which make up about $308.3 billion or 58.2% of GDP, so more than half its GDP. Switzerland's main industries are machinery, chemicals, textiles, precision instruments and watches. Don't laugh at the last one, it actually comprises a decent chunk of Switzerland's output. Anyway, it's time to move on. Monetary and fiscal policy. The Swiss National Bank, which is presently chaired by Mr. Thomas Jordan, conducts the nation's monetary policy by influencing the country's monetary and credit conditions. Swiss National Bank. The Swiss National Bank conducts the country's monetary policy by influencing the country's monetary and credit conditions. The governing board, which is responsible for determining the bank's policies, consists of 3 members, the chairman, vice chairman and a 3rd member. That's right, only 3 people are part of the board. Unlike most central banks, the Swiss National Bank sets a target rate for its desired interest rate, also called LIBOR, rather than a fixed figure for 3 months. The Swiss National Bank sets a target range for its desired interest rate rather than a fixed figure for 3 months. On top of its purpose to control the country's money supply and influence interest rates, the Swiss National Bank has a more hand-on role in keeping the CHF's valuation stable. An excessive strong CHF could cause inflation to spike and could also undermine the country's exports. With Switzerland's strong reliance on their exports, the SNB or Swiss National Bank favours a weaker CHF and does not hesitate to intervene in the Forex markets to weaken it. Favours a weakened CHF. So if it's weaker, then... Wait, if it's weaker, that means you would need less foreign currency in order to exchange for CHF. Which means the other country can pay less for Switzerland's products. So if they can pay less, then they're more likely to buy Switzerland's products, which means Switzerland is more likely to get more money into their economy. Right. Because it is a export country, isn't it? Heavy reliance on their exports. So the Swiss National Bank favours a weaker CHF as it has a strong reliance on its exports. Switzerland has a strong reliance on its exports. One of the major monetary policies of the Swiss National Bank is inflation targeting. The bank's inflation target, which is monitored in the Consumer Price Index, is below 2% a year. The bank will then attempt to influence the country's actual inflation rate through open market operations and by adjusting the Libor rate. And remember, Libor is the desired interest rate. Is inflation targeting. It's below 2% a year. The Swiss National Bank targets inflation so that it's below 2% a year by tracking the CPI. The bank will then attempt to influence the country's actual inflation rate through open market operations and by adjusting the Libor rate. The bank influences the country's inflation rate through open market operations and adjusting the Libor rate. Speaking of open market operations, the bank influences the Libor rate through short-term repo transactions. Influences Libor rates through short-term repurchase transactions. A repo transaction, so repurchase, involves selling a particular security for cash and agreeing to repurchase the same security at a later date. So it's like I was going to say it's like a futures contract, but it's not, is it? Is it? Because futures is like selling something and then in the future and a predetermined date. Oh no, futures is like buying something now and then in the future at a predetermined date I'll sell it to you at a fixed set price. Selling a particular security for cash and agreeing to buy and agreeing to repurchase the same security for at a later date. If the interest rate in the open market rises over the SNB's or Swiss National Bank's desired bands, the central bank will supply the other banks with more liquidity through repo operations at lower repo rates. If the interest rate in the open market rises over the Swiss National Bank's desired rate, the Swiss National Bank will supply the other banks. I'm assuming that's like the commercial banks, right? The commercial Swiss banks. All other banks as in like other central banks, like the Bank of England or other banks with more liquidity through repurchase operations at lower. So, if the interest rate in the market rises above the Swiss National Bank's desired rate, so if there's too much inflation, basically, then if there's too much inflation, it just means there's currency. The currency is in too much demand, and there's not enough of it going around, which therefore increases the currency's value, which makes it scarce. So therefore the interest rate goes up, right? That's how it works. So to counteract this, we need to make it more liquid, so there's more currencies floating around, or there's more CHF floating around. So do more repurchase operations, which means selling a particular, I don't know, government security for cash, and then agreeing. So if I sell this for cash, then the other party has to buy it using CHF, which injects CHF into the economy, which increases the liquidity because there's now a higher supply of cash. So if there's a higher supply, then hopefully it should decrease its value, which calms the inflation down at lower interest rates. Therefore, if it doing at low interest rates means it'll just be more likely to sell because it makes people more likely to buy it because of the lower interest rates. So, on the other hand, can reduce by increasing the repo rate, eventually increasing the libor rate as well. Yeah, so other way around as well. So, if the interest rate in the open market is below the Swiss National Bank's desired rate, the Swiss National Bank will reduce liquidity by increasing the repo rate. liquidity by increasing the repurchase interest rate. On the fiscal side, one attractive fiscal policy that Switzerland had is that they have some of the lowest tax rates among developed nations. Switzerland has some of the lowest tax rates among developed nations. In fact, it is often referred to as a tax haven nation. Corporate tax rates in Switzerland runs from 8.5% to 10%. This, in addition to its bank secrecy laws, makes Switzerland one of the most business-friendly nations in the world. I don't know if that's high or not, 8.5 to 10% corporate tax rates. I think that's really low, isn't it? That's probably really low, really low. Bank secrecy laws, yep. Getting to know the CHF. So, not too long ago, France, Belgium, and Luxembourg also termed their currencies as francs, until they adopted the cooler euro, that is. At present, Switzerland is the only one using the franc as its currency, the Swiss franc. Among financial geeks, the Swiss franc is known as a Swissy. Thanks to Switzerland's neutrality, Switzerland is considered to be politically neutral due to its bank secrecy laws, giving CHF a safe haven status as well. So, Switzerland is considered to be politically neutral due to its bank secrecy laws. Giving CHF a safe haven status as well. Usually during times of economic uncertainty, investors move their funds into Switzerland, causing the CHF to gain in value. During times of economic uncertainty, investors move their funds into Switzerland, causing CHF to rise in value. But which one is safer? Is USD safer or is CHF safer? Because USD is also a safe haven currency, but which one's more safer than the other? Because I think the main point about a safe haven currency is that it doesn't drop in value during an economic unrest, right? So, which one's safer? Because for the USD, we've seen that the smile rule that the dude came up with, I forgot his name, but someone came up with the smile US like rule. Where is it? This one here, dollar smile theory. Yeah. So, which one's stronger? Or which one's safer? Don't know. We're to find out in the future. I'm still stuck in the bling bling era. Not only do Swiss refuse to join the cool kids of the EU, but they are also the only country that still adheres to a gold standard. About 25% of the country's gold money is backed by gold reserves. About 25% of Switzerland's money is backed by gold reserves, giving the CHF an 80% correlation with the price of gold. Giving CHF a 80% correlation with the price of gold. This means that whenever the price of gold rises, CHF could stand to benefit as well. If gold price rises, CHF could also rise. So, it's backed by gold reserves. What does that mean by backed by gold reserves? So is it converted to gold reserves? Giving the CHF an 80% correlation to the price of gold. So I think this means 25% of the country's money is converted to gold. So if gold price does rise, then CHF also rises as well, right? Wait, CHF could rise. What's it mean by backed? It's supported by gold reserves. So if gold reserves rise, then CHF also rises as well. But that also means that if gold falls, then CHF could also fall as well. So, yeah. Important economic indicators for the CHF. Economic indicators for the CHF. GDP, retail sales, CPI, balance of trade. So GDP measures the country's total value of all final goods and services. Report gauges the change in country's total output from the previous periods. So GDP measures the country's total value of all final goods and services. Measures the change in the economy's total output from the previous period. Retail sales. The headline retail sales report measures the monthly change in the total value of sales at the retail level. So, measures the monthly change in the total value of sales at retail level. CPI measures the change in the prices of a basket of goods and services, followed closely by SMB as it is used to report its inflation analysis. Yep. Measures the change in price of a basket of goods and services used by the Swiss National Bank to help in its inflation analysis. Balance of trade. The balance of trade measures the total difference in value between exported and imported goods in a country. So, measures the total difference in value between exported and imported goods in the country. Switzerland has a very robust export industry, so traders often use the country's trade balance to measure how well the economy is faring. Used to measure how well the economy is faring. So if there's a positive balance of trade, so there's more exports going out than imports, that means the economy is doing well because more currency more CHF is coming in. Oh no, there's more exports than imports. Yeah, more CHF is coming in than CHF going out. So there's a higher demand than supply, which means CHF's value is going to rise. However, if there's more imports and exports, that means there's more CHF going out than there's CHF coming in. So therefore, there's more CHF going out than there's coming in. So CHF's demand, the demand for CHF decreases because there's more going out. So more CHF is spent, then more CHF is coming in. What am I trying to say here? More CHF is going out, so then there's more CHF coming in. Yep. So the demand isn't there for CHF basically. So if there's less demand, then CHF's value is just gonna fall. It's gonna decrease, I mean. So CHF is gonna weaken against the other currencies or foreign currencies. That's that. Okay, I am going to leave this episode here. In the next video, we're going to carry on with finishing off the Switzerland country profile with what moves the CHF. So thank you all for watching, and I will see you all next time. Peace.